member of the World Trade Center, Delaware. Nate Hummel, if you stand up, please. He is from WISFIS, and they are a brand new member, new premier member. So everybody, thank you to WISFIS. And we encourage those of you who are not members to become a member. As we said, you are a member of World Trade Center Delaware, you're a member of the entire network and all our partnerships. At this point, it's my pleasure to introduce Federico Mano, who is Vice President of the International Group for Fulton Bank. And is this your third or fourth time? Something like that. Every year. And except COVID, of course, and that was virtual. And Fulton is a partner with the DEC, with Delaware, the District Export Council. Janet Doherty, who unfortunately could not be here today, is locally with Fulton Bank, and she is on our board of directors. She is also part of Export Tech, and for those of you new to exporting, or within the first couple years, I highly encourage you to take advantage of this program, this training program. We're one of the mentors and trainers on that as well. When you come out of the program, you have a workable export plan. It is an actionable export plan. It's very, very hard work. We really put you through the ringers for a couple months, but you a lot of resources available. And those companies that actually work on the export tech and work their plan are very, very successful. Niraj Bhatta, you got the E award, didn't you, from the U.S. Department of Commerce last year. This is a very prestigious award for very, 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 very few exporters. So if you want to know about the program from a company's viewpoint, I hope that Niraj, you'll be able to tell them about it. Well, without further ado, I'd like to introduce Federico.
Can you guys hear me okay? Yeah, great. I think what I'm going to try to do today, I will try to, well, as you know, there's all global supply disruption going on around the world.
Can you use the microphone?
Yeah.
I'm having a hard time
The
hearing.
other one,
Yeah, can you swap it out?
swap it out.
Oh, yeah. Like this, you mean? Take it out, maybe?
Put the other one in there.
Let's try the other
Oh,
one.
Thank you.
I think this one.
Oh, okay. Oh, yeah, it's much better, of course.
Yeah.
Thank you.
Thank
Thank you, guys. You know, sometimes I get a little challenge with the technology, but I get surprised in myself.
you. You have a nice voice, I like the accent.
All right, thank you. Thank you. Very much appreciated. So what I was saying is that we need to get used to it, to this global supply disruption going on, because it will take place and it will happen and it will stay with us for a long while, because of basically the political international orders are changing. Okay, and so what does it mean? It means that there's going to be a supply chain disruption, meaning that you will deal with different suppliers, you will deal with different vendors and different markets, and therefore, as a result of that, there will be payments flows that are no longer traditional or under the establishment that we've seen it over the last 20, 30 years, but will be under new order and new establishment. Basically, what is happening is that, well, you know, we live in two silos. You either join the democratic continent of the world, or you just stay out of it. I don't want to be too political about it, but I wanted to make sure that everyone is aware of, because of course I don't work for government, I work in the private sector, and I do have these challenges going on every day with exporters and importers. They come to me and say, I can't buy that product, okay, from China. I need to go elsewhere. Well, there's a very famous restaurant in Northern Virginia, which is called Peking Gourmet Inn. It's been there probably for 50 years. You see pictures of every government official in that restaurant. And somehow the hoisin sauce on the duck was not the same. I'm used to it. So I said, well, I asked the lady, you know, she's from, I think she was from Shanghai. You know what, I'm sorry, sir, I understand what you're talking about very well. We can't buy anymore that hoisin sauce from China. It's coming from Taiwan now. Okay, and we're talking about a sauce. You understand that? So I'm talking about drilling it down to the most, smallest line item on that, tariff schedule, of either on the inbound or an outbound shipment. Outbound meaning exports, inbound meaning imports. Anyway, having said that, there are challenges, but there are also opportunities. With challenges, you always have opportunities. These are some of the payment options. I guess I gotta be near here. So these are some of the payment options that you may be faced with, and we'll go into more details as we move into the next few slides. But obviously, the most obvious to you as an exporter is going to be cash in advance. It works, but it's very limited. And if you're in a company that emphasize growth, I would stay away from that because that will really limit your growth. Okay, levels of credit, they can be a bit complicated. Can be a little bit complicated because obviously we work with that every day as a bank. But there are times where, as an exporter or an importer or a combination of both, that you may have to use those simply because it is dictated in your contract. Okay, your contractual obligations, and that's how, for instance, if your supplier sells you against letters of credit, well, you're gonna have to issue a letter of credit. Okay, if your buyer is used to letters of credit, well, you're the exporter, you gotta receive that export letter of credit as a form of payment. There is no way for you to get away with that. Talk to your local banker, they will tell you exactly how to move forward in that process. Export credit insurance policy is extremely important. It is important because of the fact that, because as you move down to open account, which you're familiar with, most of you should be familiar with, because basically you sell it to domestic buyers, you issue an invoice, and your invoice is gonna be net 30 days. So basically, it is an open credit terms. So having said that, I think I'm gonna face myself a little more like this. So having said that, yes, open account is gonna be a little more what you want to go, what both of you as an exporter and importer, buyer and seller, you wanna go into that because of the fact that you wanna increase your sales, you wanna be comfortable with each other, you got insurance coverage to do that. Because remember that when it comes to insurance, not only you have an export credit insurance policy, but you also have a domestic. So if you're an importer and you buy goods from overseas, and you sell it to your grocery stores, and you want to have financing against that, now you need to talk to Pete over here. This is going to give you coverage on those domestic receivables. Okay. State and federal finance programs and accounts receivable financing. Those are the ones we'll be talking about very shortly. And obviously we talked about Exim Bank, we talked about insurance coverage, and we're talking briefly about SBA. And each of them, each program, each government program, each state program is there for a particular purpose. You just need to make sure that you talk to your broker, you talk to Exim Bank, you talk to your bank, and they will then consult with you and provide you with matching. With as many options as possible. All right, next slide. I wonder if I should stand over there and talk loud, so we won't go back and forth with this. I will try to be as loud as possible, okay? All right.
Can you guys hear me okay here?
Yeah.
Better, okay. So, when we use trade products, we want to mitigate risks, commercial risk and sovereign risk, okay? Commercial risk, what that means is that you invoice someone and you have a payment term over there in place based on your contractual agreements, but you are now not getting paid, so there's a default, okay? So that's a commercial risk. all right? And sovereign risk, what Eric said earlier, you know, it means basically the political risk of the country. You know, the country risk, the economic risk, you know, default of the country on the foreign debt. Those are factors that you need to calculate as you buy the insurance coverage, because insurance coverage, you know, will actually cover that. And obviously, you know, you can use Exim Bank, and you can use also private carriers. Also, keep in mind that it's interesting that you not only, we get very highly involved in foreign exchange. I think most of you probably are involved strictly in US dollar exports or US dollar denominated exports. But if for some reason you need to sell in a foreign currency because it is dictated by your buyer under contractual obligation, keep in mind that insurance coverage can also be denominated in the foreign currency. And then, of course, you get involved in foreign exchange. It will provide another extension of risks, because obviously foreign currencies fluctuate. Okay, you can go that in that screen, Reuters, Yahoo Financials, Bloomberg. You'll see that exchange rate fluctuating constantly every second. So you need to basically we'll get into when we'll talk about foreign exchange in a little while. So again, provide secure methods of shipping and documents. Remember that documents, when we're dealing with documents, shipping documents we're talking about commercial invoices, packing lists, certificates of origin, certificate of inspection, and the most important of all, it's gonna be an ocean bill of lading. Okay, the ocean bill of lading, it is your title document. Okay, without that, you're out of commission. Okay, because that's a title document that is endorsed over to a bank or to someone that you feel comfortable endorsing it to as your shipment leaves their warehouse into a container on top of a vessel going to Italy. I wonder why I said Italy. France, but certainly not Russia. It's not gonna go there, believe me. I guarantee you that.
Viva Italiano.
Huh?
Viva Italiano.
Yeah, there you go. I like this guy. All right, so basically, also, you need to make sure that in that working capital line of credit that we talked about earlier, and we're talking about short-term working capital lines of credit, that's what we're talking about. You know, basically, the buying and selling of goods, you know, up to a year. We're not talking about long-term, even though I must say that a lot of the products that Exim Bank offers, which are the medium-term loan guarantee programs, they're great, you know, especially in developing countries, and they go up to 5 to 7 years. Is that correct? Correct to say that? Oh, the medium-term 5 to 7 years. They're still the same. I'd be kind of out of that. I used to be very involved in medium-term back in the days. You get it, but I think now there's more short-term, I suppose. So what's that, half and half?
It's probably been half and half. I mean, there's been a lot of short-term influx over the course of the past years based on COVID, because people are just, everybody's skittish,
Yeah.
financially right now. It's just the way it is.
Yeah. And sometimes actually the structure of the credit could be both. It could be a situation, you need short-term financing, you know, you need to make the product, right? And then on top of that, you might sell machinery, you know, to the same customers overseas, and that's more medium term, you know, 5 to 7 years in terms of repayments. These machines, these are capital goods, right? That's the capital goods, there's a life, you know, in that machinery, and so you can't expect to have a short-term 1 year repayment. It's gonna be 5, 6, 7 years, because the machine's gonna have to turn the product in, and it's gonna have to generate revenues out of the sales and repay the loan. Yeah. All right. So yeah, the pre-export, it has to do with, you know, hiring engineers, buying your materials, so you can put that product and service. By the way, speaking of service, the US is a net service surplus driven economy. Basically, we produce and sell more services than actual goods. As you know, we have a trading balance, right? Trade deficit in goods. However, I must say that it's interesting, you know, Russia-Ukraine kind of situation. fact that the EU, the European Union, has declared, well, you want to say war, but a ban on Russian energy products. 75% of LNG from the US is currently hitting the European markets. 75%. That's the liquefied natural gas. So we're becoming a global superpower in terms of supplying, gas. Okay? And there's still capacity. There's still capacity, and that means it's going to have to be a political move from the current administration to open up more in the US, to produce, export, and that means even additional investments to support all that. Terminals and so forth, okay? So, and energy and food. Food, US can produce a lot more, because as you know, Russia and Ukraine produce like 1/3 of the food supply chain in the world, or at least they used to. Now everything's banned, who knows what's going on. But that could be also the potential too. Support and facilitate trade. All these trade products will be denominated in foreign currencies, under foreign contracts. That's something we need to work with, depending on what negotiations you have with your buyers. But like I said earlier, let's talk. Okay, let's talk. All right, here we are. Types of international risks that we try to mitigate as a bank for you guys, for you exporters. Sovereign risk, that's it. You have right there. War, political, economic, natural disasters. Okay? Commercial risks basically is default of payments. Credit, worthiness, foreign exchange, fluctuations, legal documentation. Sometimes, we work with certain instruments of payments, where there may be letters of credit, where there may be commercial letters of credit, where there could be bank guarantees. The language we see that come out, that's why we always try to get a draft from the foreign issuing bank, so we can see, do we have something we can work with, okay? Can we deal with this? Because some of the terms and conditions can be pretty rough to work with, so then we need to work with the client, we need to work with you guys to make sure, okay, this is fine, we need to change this, we need to add this, so that we can make it, like a workable piece that we can deal with. Because these letters of credit that I'm talking about, these are eventual flow of payments, okay? There are underlying flow of payments that come out of these letters of credit to pay you, okay? All right, let's go to the next one. Aha, these are risk mitigation techniques. I'm not gonna go over extensively, but cash in advance, of course, is the more favorable, or the most favorable for the exporter, seller, outbounder, okay, going to sell it to foreign markets. That's easy, but like I said before, it limits your growth. If you want to expand and you want to go, I don't know, $10 million in revenues in 5 years, that's only going to take you so much, okay? So then you need to negotiate your terms. You need to back your buyers overseas, into your foreign markets, into your buyers. Okay, by the way, can we do letters of credit? What are your typical methods of payments? Okay, they may say, okay, well, for the US is XYZ. For Canada is ABC. Okay, but that's a negotiation. You talk to your buyers, you negotiate, you need to be in communication with them, because that's the only way you're gonna educate yourself. If you want to, after you talk to the buyers, come back and circle back to us, okay, to the insurance company, to Exxon Bank, to your local banker, and tell us what discussions you had with them, what feedback you got, okay? Send us documentation. Then we can kind of circle back to you and provide you with, input, feedback, or what we think may be suitable, okay? Yeah. Letters of credit, we'll go more into, later on into details, but basically there are two ways. One is confirmed, one is unconfirmed. Confirmed means full bank pays you. We confirm the credit, you present doc. By the way, a letter of credit is not cash. Okay? And back in the days, I used to pull cash out, but to show cash to customers, unfortunately, we can't do it anymore. Even though there's a little interesting story about previous CEOs of some former banks, I think Peter will be aware of, and then what they did sometimes in town hall meetings. But anyway, this would be like 30 years ago. So, but anyway, a letter of credit, it is basically a document, a payment instrument that is payable to you, but it is not unconditional. No way. You need to present documents that are required under that letter of credit. Okay? And the documents we talked about is the one I said earlier, right? The commercial invoices, the usual stuff that you're aware of anyway. If you're exporting overseas, these are the documents you need to present. All right. That's confirmed. That's when we confirm the credit. That's when we take our willingness to confirm it and pay you. Unconfirmed is when we just simply advise the credit to you. You present documents to us, and we'll go out and reimburse ourselves on the issue bank or a third party that is written under the letter of credit, where we allow to reimburse ourselves. But whatever you do, whether it's confirmed and unconfirmed, it really doesn't matter. The most important thing you have to learn today is that you need to make sure that documents that you present have no discrepancies, are in conformity, or they're fine. And I have a very simple solution for you. If you feel like you're overwhelmed by all this, don't worry. Earlier we talked about freight forwarder. You sign the power of attorney to the freight forwarder, enable them to prepare all these documents under the letter of credit on your behalf, the exporter. They're experts. They will make sure there will not be any discrepancies. That's what they do. That's their job. And you make sure when you interview with your freight forwarder or your customs broker or whatever the hell you work with, by the way, not DHL, FedEx Express, or UPS, because they couldn't care less. Sorry. I hope there's no one here that I'm offended today. Because I mean, I've had situations where, they go there and then we see documents. What we prepared? Well, we went to our FedEx, okay, well, yeah, there are discrepancies here, okay? Just go talk to a freight forwarder that's really in the business. They're doing international shipments, okay? And so, yeah, they'll do it for you, no discrepancies. Well, export insurance, SBA, Exim Bank, we talked about that. Private export insurance, we talked about that. Documentary collection is also another form of it. As you can see, the chart, right, goes to less favorable, right? But obviously, even if it becomes less favorable from an export point of view or an exporter point of view, well, it doesn't really matter because you still have insurance that you can mitigate the risk with. Documentary collection is another form of payment. It's like a flow of documents between banks. Does not give you the same kind of guarantee as a letter of credit, okay? But still gives you some assurances that you will get paid because the flow document is not between yourselves. It's not between the importer and exporter. The flow documents under documentary collections is between banks. Okay, so at least we do have some control, not as strong as the letter of credit, but we do have some control in terms of seeing the documents, seeing the title documents, making sure that before we release that, we're collecting money to pay out to the bank or to pay out to the buyer's bank. Okay. Open account, we know what it is. All right. I mean, if any of you sells, maybe this is not the market, but the DC market where I am, you look at government contractors all day long, and they do. When you sell to the federal government or state, it's your net 30, your net 60, your net 90. So you gotta get used to the open account terms.
Can I ask you a question?
Yeah.
Are those freight forwarders that you were
Freight
talking about?
forwarders, yes,
Right.
yes.
That do
I
all
like
the
that.
paperwork. That sounds like a wonderful asset to have in your corner.
Absolutely. You connect with me. Some of them actually are even our clients.
Okay.
Because remember, this a freight forwarder, what it does, they handle shipments.
Right.
It doesn't matter
Right.
if it is a container that they handle, or a pallet, or a consolidated shipment.
Right.
So pick up, their truck goes to your warehouse, pick it up, and brings it over to the vessel, and the vessel goes to France, right?
Yeah.
So you can have your Beaujolais once you get there, but anyway, that's a whole different story. But, and so they have agents overseas.
Right,
They have their own agents overseas that handles the cargo
right,
once it hits the port,
Okay.
or once it hits the airport.
right.
Yes, sir.
Let me.
Oh, I'm sorry.
So those same freight forwarders that are good at exporting,
Yes.
are they also good at importing?
Oh, yeah.
Yes.
Yeah, absolutely. You've said, well, first of all, I would say you interview them, okay? Because normally speaking, yes, you're right. But there may be some freight forwarders that only handle outbound shipments, exports.
Right,
Because if you handle inbound shipments, you must have a customs broker license,
okay,
which is,
yeah.
expensive, because
Right.
you obviously bring into the company a set of skills, resources that can handle that. Because remember, these containers come to the country after 9/11. It goes through a very rigorous oversight. I mean, they get scanned, those babies. And if you, oh, by the way, if you're a first-time importer, be ready to accept delay. Because if on that charter, okay, you're a brand new customer, a brand new importer,
Right.
and your name is not there, they're gonna take the container apart. Okay? Yes, sir.
I just wanted to support what you were saying to him. I just finished talking with my freight forwarder.
Yes.
I have about 2 containers worth of furniture from Lexington, North Carolina. I only made a payment. I called him, and he's now picking it up. He wanted to let me know that, hey, when my truckers get there, all the product have to be in the same place. They're not gonna leave there to go pick up anywhere else. Nothing else will be added to the container, which you did not send me for the invoice.
Right.
Because if your container gets scanned at the port, and anything else is discovered in it, you will be charged for the delays, for
Yeah.
the logistics,
strict.
for every single
Yeah,
thing.
that's true. It's very
So it
strict,
is
yeah.
highly important to have a
It's
freight
very
forwarder
important
who
to
knows
talk to
how
your freight
to-
forwarder, and don't forget to ask questions. You
That's
gotta
right.
ask questions,
That's right.
questions and questions, because that's actually part of, we're talking about mitigating risk, right?
Yeah.
That's your mitigation.
Yes.
I mean, I can mitigate you as much as I can from a banking perspective, but that's something you gotta know your KYC, know your customer, right? The gentleman here is absolutely right. You need to make sure that you have extensive conversations with them. Yes, move on. What is a letter of credit? Gee. All right, so a letter of credit is a contract, right? We have 2 parties. We have the buyer that goes to the bank and has a credit line in place and is applying for a letter of credit, is issuing the letter of credit. So we have a contract. And then, of course, we got, a seller, right? So the seller will be you, an exporter. And basically what it is a situation where we, as a bank, are replacing your creditworthiness with ours. So what does it mean? So basically that our creditworthiness, a bank, large bank, is much greater than you as an individual company. So that gives the comfort zone, and a guarantee of payment, all right, that you need to basically obtain, achieve, when you present documents. So basically, by replacing the creditworthiness of our customer with our own, we're guaranteed payment to a third party, to a beneficiary. By the way, I'm not sure if there's any here, but when you choose your bank or your local bank, make sure that the bank has their own international banking department. They have their own SWIFT, okay? Because, and has of course a vast network of foreign correspondent banks overseas. They can correspond via SWIFT, which is an authenticated electronic payment system, as well as a delivery dispatch point for credit instruments, levels of credit, okay? These, they go into like an empty series And there will be, you know, for collections, for letters of credit, for bank guarantees, and it's all via SWIFT. If you don't have a bank that does not have SWIFT, is extreme. Be a member of SWIFT is very expensive. I think the minimum annual premium is roughly $500,000. Okay, so it's not like this. It's not like they. Sorry, it's somewhere between $300,000 to $500,000. It's not something that is established and given to anyone. There's a lot of KY. Swissnet is an organization based in Switzerland that basically you have to go through a rigorous process to become a member of SWIFT. We're on SWIFT ourselves. Yes, sir.
So what's more valuable, a letter of credit or a bank reference letter signed by a bank executive?
No, I think, you know, to me, I mean, there will be different opinions out there, but to me, the most powerful instrument is gonna be a letter of credit. And we'll go over this in a minute or so. There are two types of letters of credit. The commercial lenders, have the commercial lenders left? So I can discuss this freely with you guys. Oh, okay. Are you a commercial lender?
Yeah.
Okay, but I know that's some other commercial lenders, but yes, go ahead, please.
What is an irreversible letter of credit?
It is something that we don't deal with. We only deal with irrevocable. Okay, that's all deal. Irreversible to me, when someone mentions that word, irreversible, I have red flags coming into my spine. I have a compliance officer coming to me saying, what is this? Yeah. So there are two types of letters of credit. There is yeah, you're welcome. There's a trade commercial letter of credit, and there's a standby letter of credit, right?
A standby?
Standby or bank guarantees. And basically, there are two different purposes. A commercial lender will always confuse that with a standby because basically a standby is what they're used to it. You know, you build a road, the state government agencies are, you know, you gotta build this road, okay, fine, you know, you gotta put up a performance bond, right? To finish the roads, do the pipes, do whatever you need to do, okay? $500,000 for 2 years, you know, because it takes you 2 years to do it, and if you don't do it in 2 years, then we extend it for another year. Okay, that's what commercial lenders are used to. The performance bonds, standby levels of credit, okay? Basically, they're there in place to, you know, to basically they're in place to make sure there are not any contractual obligations, defaults, okay? But they're never, I repeat, never, you wanna write down, drawn against. They're not supposed to be drawn unless it's a default. Okay, that's number one. That's the most widely used type of letter of credit in our country. Okay. Then you have trade commercial letters of credit, the export letters of credit, the import letters of credit, and these are always, write it down again, drawn against. Because these are for payments, these are for trade, these are for commerce, these are for transactions, okay? So they will always be drawn against, all right? Okay.
I think to his question, it's not like a credit reference or like a letter from a bank executive. That's not a letter of credit. Letter of credit here is that an issuing bank is providing a credit enhancement to your buyer. In that once the LC is issued, we're taking it's an irrevocable undertaking that as long as you do what you say you're going to do, the bank is going to pay you. So whether or not whatever happens on our end with our customer, the responsibility is on the bank to pay the beneficiary. So that's the credit enhancement that your beneficiary, or if you're an exporter, that you're receiving from your buyer, that you no longer have to take the credit risk of your buyer, you have it on the bank. So you want to get a letter of credit from a reputable bank.
Correct.
Yeah, so and standby LCs is like a secondary mechanism for payment, like you said. So like what you're doing with like servicing contracts, that's a perfect example for standby LCs. You provide your services, you have your customer provide you a letter of credit that you're the beneficiary of. So if they don't ever pay you after you provide services, you can draw on a letter of credit with that bank to get your funds. So that's the benefit for you.
Yeah, and sometimes in standby level, we also use an international standby letters of credit for international purposes. Like for instance, the service industry they use, like if you're like an AI company or maybe software company or IT company or maybe biotech company, maybe life and science type of company in the service. There will be a lot of situations where you have contracts where you have advance payments. Okay, they're willing, because obviously the buyer of the product or the service is willing to finance the growth of that project. So they're willing to provide, either 40% down and 50% down, but then they may require from you for an advance payment guarantee to basically support that advance payment. And then we'll get into a letters of credit where do have, those conditions where we can say, okay, well, we issue this advance payment guarantee. It is under the condition that upon receipt of down payment from you, that will make sure that by an amendment, this letter of credit will become official, valid, in place. So there are ways to negotiate that in your contract that we can be involved with.
Okay, thank you.
I'm sorry, go ahead.
Just adding a quick note to it. When I received my letter of credit, it was kind of confusing to me. So what I did is I built a flowchart. I first submitted a full corporate offer with detail of the product, time of the production and delivery, and they sent me a corporate contract, basically saying, if we need X, Y, Z, we're gonna send you this document, this document, this document. You produce this document, this document. So it's kind of like an SOP. But if you don't simplify, your team members can be confused. So what I did is I built a flow chart.
Perfect.
If it's not yes, then go to the left. If it's no, then go here and here or here.
Or maybe, then it's to clarify.
There you go. So anyone, if I'm not right now in the office, anyone can handle it. Because before you do or you click your button, this is the document you need at this stage of the process. So
That's a great model.
I can share if you like.
I'd like to see it myself.
Okay.
Thank you. I'm sorry,
No, I was just trying to add something on the letter of credit. As I
Yes.
mentioned, I have been in this international business for past 25 years. So I would definitely, when you go for ask for letter of credit, the first thing is important. The bank has to be the first class bank, because rest in the world, banks are there giving the letter of credit, but if they are not a first class bank, probably again still you are at the risk. And they do see your documentations dot to dot. If there isn't a dot on the LC, letter of credit, letter of credit, make sure you put all the spellings and everything correct as per the letter of credit. Otherwise, they can.
Shall I continue?
Yeah.
I'm sorry for the interruption, because the big boss tells me that, I need to move on, okay? So, commercial letters of credit, of course, they issue in support of trade transactions, as I said earlier. There's a trade transaction, there's an export trade transaction, you have a buyer and a seller. They're meant to, as a payment mechanism. It is, obviously the payment is triggered by percentage of documents that are required under the letter of credit. And if the documents are in order, like I said earlier, there are no discrepancies, then obviously the bank is under the obligation to make the payment. That's why it's called, guarantee of payment. As long as you present those documents, they are compliance. So use your freight forwarder if you're not too sure about it. It mitigates commercial risks, because obviously the issue bank is replacing the creditworthiness of the applicant with their own. So obviously that's our own credit, which is much stronger in terms of credit backup. And of course, it can mitigate all these risks that we talked about it. All right, and it can be negotiated in foreign currency, and it can be also confirmed letter of credit. We go on to the next one. Okay, value of confirmation. This is pretty simple. Basically, whether it is the letter of credit is we call it payment tenor or payment terms for you guys. But a commercial letter of credit will have terms such as a cite, meaning upon presentation of documents, you get paid as long as the documents are okay. But they also defer payments, or we call bankers acceptances. And deferred payments could be like net 30 days, could be net 60 days, could be net 90 days, and so on, or could be maybe 30 days from ocean bill of lading date. These are deferred payments.
Either way, we're still obligated to make a payment, especially for confirming it. You know, obviously, we will pay in maturity. However, you do have on a confirmed letter of credit that we will confirm because we feel comfortable with the bank credit risk, we feel comfortable with the country that where the LC is coming from, we feel comfortable with having a credit line for the foreign bank, and we feel comfortable with being a letter of credit that we can work with in terms of, you know, the documentation that is required, right, to get paid. Well, you have the ability to discount that. So, even though it's 90 days out, you can bring the documents to us and then compliance, we're confirming the credit, we're discounting it, and we pay you a site. Okay, no questions asked. And that's actually a great way, well, of course, we'll have reimbursing instructions in the letter of credit. That's our due diligence that we do all the time anyway. And then we'll get reimbursement from the issuing bank. What I wanted to say is that could be a tremendous, tool for you as an exporter, because on one hand, you are getting paid by discounting the letter of credit, you're getting paid the site. On the other hand, you know, the buyer of your goods, you know, you can basically get the merchandise, because, you know, the payment on the letter of credit is 90 days out, right? You can get the merchandise, you can sell it in his market, collect his money, and then when the maturity date comes around to pay his bank, the money's in his account.
Yeah.
Okay? So that's a tremendous, well, I would say, selling tool to offer your buyers overseas. All right, so anyway, finance, there are some fees involved there, and we can talk about that, but normally fees and letters of credit, from a minimum of 50 bips or 50 basis points, it could be as high as maybe 1.5%. And maybe even slightly higher depending on the risk of the country, the risk of the, you know, of the bank itself. But keep in mind that will be the range. And hey, you can always call me, right? You can always send an email. I can give an estimate. You know, you just give the only thing I need to know: the name of the bank, the country, the dollar amount, and what tenor, what site, whether it's a site or a deferred payment. And then I can just run those now, that information into my little model. Ping, 1.2%. Okay, it's simple. Okay, it's not that big deal. All right, so here we are. Standby letters of credit, here they are. They're issued to support an obligation from one entity to another. Okay, they're not intended, you see, they're not intended for payment mechanism. So it's there to support some kind of, well, a contract. Contract may say, okay, here, you know, I'm giving you this road that is mine, and now you're taking over this road, and because you need to develop this road, you need to develop this field, okay? But in order for me to be protected, because I don't want to get screwed, excuse my French, I want to make sure basically that you put up the standby letter of credit in place so that, you know, if there are any defaults, I can trigger that payment. But if you guys are complying, and I'm sending inspectors over, and you got your trenches, and you got your stages where it's developed and so forth, it's fine, no issues, okay? Then this can have a commercial and financial application as well, such as clean LCs, financial LCs, insurance LCs, and I think, you know, the most stuff, the basic stuff you need to know is down the bottom, okay? Insurance LCs, we do get insurance, that's more domestic, where basically, you know, an insurance company, they require a letter of credit from its customer, and then they're asking for us for a standby letter of credit. But I think the most important thing for you on international trade is gonna be the bond line. Bid bonds, normally if you go to Algeria, you need to bid on a contract, they need to have a bid bond, okay, for you. So you gotta go to the bank to have an international bid bond, you know, issue. Which then becomes, if you win the tender, then becomes a performance bond, okay? Because obviously it becomes more like a warranty type of bond where you need to, you know, ensure that you're performing under the contract for the supply of machinery, okay, for an extended period of time. And advanced payment guarantees, what we talked about earlier, when new customer sends you money, you know, sends you money, and
well, you know, yeah, they're putting money up front, you need to protect the money as a buyer by asking them, you know, you as exporter, to do an advance payment guarantee to the bank. Documentary collections, you know, as you remember on the chart, is less favorable, but, you know, obviously, it's intended for payment mechanism. It's, you know, a flow documents between banks, but there's no engagement, there's no guarantee of payment. The very little risk is mitigated. I don't think I've ever seen a default, you know, in my experience. In 40 years, I only worked for about maybe 2 or 3 banks. But you know, sometimes you change names, but it's the same bank. But yeah, I mean, that's very little risk is mitigated. This documentary collection will be driven by your negotiation with your buyer overseas. They will ask you. And normally the way it works is that it starts cash in advance, letter of credit, comfort, you know, is established between your buyer and seller, documentary collections, and the last is gonna be open credit terms. Because obviously, at that point, you've done business for a while, so you trust each other, you met, you feel comfortable, and then you go into net, you know, open credit terms. Okay, open account transactions, there's complete trust between the two parties, buyer and seller. All the transactions we see in the US, in the US market, are basically, you know, open account terms. That's what you see there. Sometimes there may be domestic insurance coverage on that, but it's not only based on default situations, it could be based on the fact that the bank may require maybe additional credit enhancement, so that you can then have a larger line of credit, so you can grow more, you know, for your business. That is also used in that respect. So, how are we doing time? Are we over time? Okay, well, I'll move fast then. Oh, by the way, if there are any questions,
Yes.
okay, go ahead, please.
Are you willing to share your PowerPoint?
Yes,
Yeah.
everything, all videos, everything will be shared.
Okay, thank you.
All right. There you go, Incoterms, that's a very important here. And that will be something you will work with your freight forwarder, your shipping company. I'm gonna go over some of the line items, which I think is very important to you to know. So that is very important because that, you know, those will be your, basically your shipping terms. So your FOB, your X-Works, your CNF, your CIF, duty delivered paid. You know, and then that's also part of your contractual negotiation when you buy overseas, okay? And then you may have a buyer that says, no, I got my own freight forward in Baltimore, I got my own freight forward in Wilmington, I meant to say, Wilmington, okay, Delaware. And no worries, I got my freight forwarder in, you know, in my outbound freight forwarder in Wilmington, and he's calling from Brussels. Hey, make sure you go there and collect that container from this guy. That's X-Works, okay? That's basically X-Works factory, right at the floor of the factory, getting out of there, okay? That, he wants to take the risk, the buyer, and that's fine with you. All righty. These are the products we talked about it. I think the only thing I want to say, these are great products. I'm sorry, Rick, I should put Exim Bank in front of that. But anyway, these are great, it's great organizations. SBA, Exim Bank does a great job in insurance. The insurance Exim Bank is amazing. We have a lot of international lines of credit in place where we use the Exim Bank insurance as a backup for our credit collateral to basically establish international lines of credit to finance exports, okay? So we use it all the time, and we have a great report at Exim Bank, and we monitor those insurance policies, and we talk to them, and there's a software in place to monitor all that, so we feel great about that. Direct financing, no, that's, yeah, it's value for your trade. Now is the time to ask questions. Oh, my information is there, just in case you want to try to move down there. Any questions? Yes, sir.
Given the complexity of a letter of credit and the differential conditions between various continents, let's say Africa, Middle East, Europe.
Send me a note
Okay.
Because normally, what you're referring to, and correct me if I'm wrong, you're referring to country risk assessment score. And there is a model there where I put the numbers and I come up with a ratio. 3 and above, it's a country that the OECD, which is the Organization for Economic Development, some they're based in Paris. I've actually called on them years ago in other life. They established country risk scores based on their political systems, the economy, corruption, and so forth. Okay, so it's a huge, very complicated model.
That was not actually my question.
Oh, oops, sorry. What was the question?
So I represent a Canadian company and we provide their equipment to laboratories in West Africa. The Canadian company, government has a type of insurance in place to support them in collecting their money.
Okay.
Meaning, if a company here in Africa doesn't pay me, if we've gone through this type of information through the Canadian embassy in Abidjan or in Burkina Faso or Mali,
Right.
if the client doesn't pay, the Canadian government would supply the money.
Well, that would be what Exim Bank does, right? I mean, if basically.